Yeah, I'm losing my edge.
The DV01 is the topic of conversation today, Pete. And this is going to be a fun one. DV01 is something that you and I have personally been working to destroy. And we're like right there. We're right on the edge of totally permanently.
We could see the end in sight. Absolutely.
It's going to be hanging out with the dodo bird and the dinosaurs and everything else very soon. We're going to get rid of DV01 very, very soon. But until we get options on the small exchange interest rate products, Pete, I do have a last vestige here in DV01, a last use for it, because I want to look at the S10Y product, this newest interest rate product that's out there. It trades in yield. A lot of movement here to start the week. As you can see, bond prices are collapsing and yields are getting back to levels that they haven't seen since before the pandemic. Right. Really big move, really intriguing market here. And with these futures getting back to normal levels, it might be time to hedge if you're long, or just look at some different ways to construct trades, because it's one of those things, Pete, with a dynamic market, your strategy has to get dynamic as well. Like, and this is something that I've been working with both you and Michael Goff on, how your size of trade is a result of, you know, how much edge you think you have in that market. And when this market here in yields was down at, you know, $5, $6, $7, which is 0.5%, 0.6%, 0.7% in the 10-year yield, lows that we've never seen before historically, that's when we were like, oh, we're buying these things. Right. And I think there's a lot of edge in buying these things. Now, as they return to normal levels, you know, north of 1.2 or 1.3%, you have to adjust with that change in the market, right? Maybe not so big of a long trade here, right?
Absolutely. And you know what? I think you hit on a perfect spot, is that, you know, as much as we look at these extremes, nothing moves. You know, if you go back 3 years, normal is closer to 170 or 17 in the index here. You go back 8 years, normal's close to 35. You think about that. Yeah. Wow, 35. And yeah, and you know what? Do we get back to that normal? I have no idea. My slant is that we get somewhere between here and 35 in the next 12 months. But it's not going to get there in a straight train. And, you know, it's so funny because we're long some smalls 10s against some other stuff. And I was just about, before the show, I was just about to peel some of them off, because you're absolutely right. As we start to make that move, we know there's back and forth. We've gotten a move, and we always talk about this. 66 ticks we're up. Almost, we're back to that 2 standard deviation level in terms of movement. You know, you could almost make the case. And so how do I take advantage of that extreme? Well, you can either lighten up if you have multiple units, which is a great benefit of smalls. You could turn yourself around and go short. I don't know if I'm going to get that clever right here, but where a place to lighten up, absolutely.
Yeah. And so that's what we're talking about here today, because thankfully, before we get those S10Y futures options, which are coming as soon as we can possibly try, it's funny because we appreciate all the feedback, and please go to a Small Exchange Twitter and email Pete if you want. Pete at smallexchange.com.
No, it's peter.molmap, but always email me. Absolutely.
Peter.molmap.
And if you do email me, I'll send you Frank's address. So
send him all your feedback, because we do appreciate the feedback, but it's constantly like, where are the options on these futures? You guys need to add options. We aren't sitting here twiddling our thumbs. Our team is working to get those options out as soon as possible. Now
we've actually whittled down our thumbs. I don't have thumbs anymore. So we've used up all our thumbs.
What we have to use up until our thumbs do get those S10Y futures options going is some DV01 and some ZN futures options. And like I said, hopefully, I mean, in the next couple of months, you'll never have to think about DV01 again, especially as we add more interest rate products. There's no DV01 when you're going from one yield to the next, Pete. It's just 1-to-1 ratios. And when you're talking about, you know, futures options on these products, you don't have to worry about any ratios or anything else. So this is the last reason for using this DV01. Start out, though, you can see that ZN futures move in almost exact opposition of S10Y. So this is what we're using here for this interest rate options piece to, like Pete said, maybe look at lightening up that position. And you can see here, using the dollar values of a basis point, you can equate the exposure across these different interest rate products. Now, in most of the content that we produce, we say that S10Y, it's about, 7 or 8 S10Y contracts per ZN. And you can see here that a $10 move equates to about an $85 move in ZN. So it's actually exactly right now, 8.5 S10Y contracts per ZN. What's really nice about S10Y, and when we add the 2-year and the 30-year and maybe even some other different durations across the yield curve here, is, Pete, the dollar value of that basis point is going to be $10, $10, $10, no matter what product here, as opposed to ZN right now, it's $85. ZB, it's got to be north of 100. It's very confusing,
Absolutely.
right?
And you know what? And don't memorize the $85 because, as Frank pointed out, it's dynamic. And let's not even get into it because it's a function of a lot of different things.
You don't want to talk about convexity?
No, I don't, because it's torture. I mean, again, I always equate, teaching rates to is like a comedian trying out material. You keep going down that road and you keep losing your audience. So there's so much of a lift to be able to trade treasuries in the olden days where we started out with products that have so much complexity. But we were on a call this morning and we talked about the idea that if I can't explain the product in 3 sentences, I built too complicated a product. This slide is the perfect example of that. Yep. Because you run through that dollar value of a basis point, which stays consistent, the tick size, which stays consistent. That's it. You've explained none of these pieces move, all that moves. And this is what we want. I want something that just moves. The only thing I want to move is price. I don't want all these other gears within that pricing mechanism. We'll drive it, and I will just add another level of complexity and disconnect between the product. That's what's so important here.
Well, yeah, and what's funny is DV01, and you're, in my mind, and anybody else who's broached this subject before, it comes with this kind of confusing, negative, complex connotation, because it's like, oh man, it's dynamic, like Pete said. It has to do with the convexity given the duration of the bond product and where yields are at and everything else. But what's funny is if you boil it down to a very simple concept within the small interest rate products here, right, Pete, what is the dollar value of a basis point? Okay, so we're talking about a basis point, which means if percentage yield is at 1%, a basis point is just 1.00% up to 1.01% or down to 0.99%. Right. That is a basis point. Or 100 basis points is 1 full percentage point. What's really nice is at the smalls, that 1 basis point is just a dime. It looks like a dime. It's just $10. It's the difference between going from $10 even to $10.10. That's the same as 1% to 1.01%. Right. And so it is a pretty simple concept for people to get on board with. But yeah, when you have to lend it to these traditional treasury notes and bond products where the DV01 is changing with the environment there, and it's got some apostrophes and everything else, it's a little confusing. But what's nice is we boiled it down here to for you, Pete, to just 30 seconds in ZN is about a basis point right now for that product. So that means that every about 30 seconds or 3, I guess, full ticks, you want to say, higher would be about a dime lower in S10Y. And you're seeing today, last time I checked, the ZN futures were down about 21 ticks here, which is equating to about 70 cents higher in S10Y. It's a pretty easy thing to get on board with when you're talking about ratios. And so I took that a degree further. If you wanted to, Pete, say you had your long S10Y futures and you wanted to sell a call here today using DV01 and using the options in ZN, the 134 put in ZN futures, given all that math that I just did there, the 134 put is equivalent to about the 14.5 call in S10Y futures. And so you can see it illuminated there on the chart. If I'm long from maybe $10 or $11, or even just putting this trade on today, and I want to reduce a little bit of that exposure, put on a covered call, selling that 134 put in ZN against the longs in S10Y would be equivalent to selling the 14.5 call, Pete.
Right. And you know what? It's it's as clear as that. So we're creating, we're creating a synthetic instrument that gives us cost basis reduction, gives us premium, and premium I think will become more and more interesting as these rates start to move, where it's been a tough fight to be able to collect anything. So I love the way you broke this down. And the idea here of the hedge, again, remember, two negatively correlated products in terms of the inverse relationship. That's why we're going to the hedge piece is that taking off the same size, the buy, the sell side. So I love the fact you're showing here in a very simple way. How do we go about looking at that call? Well, it's because of the inverse relationship, we're looking at that put, but that's the hedge. So very straightforward piece here. And I love, I think it's very interesting, and it's very, once we do get the options, you see the power of being able to add that piece to the equation here. The way you broke this down, I love, because it puts our products without options into that world of a lot of what we have is not perfectly correlated. So we work within a pairs trade that doesn't have correlation because we find opportunity. Here is something we wanted to have a tool. There's both opportunity with things that have a strong correlation. Now, here's an example of something that has a perfect correlation and lends itself to that smalls and piece.
Yeah, absolutely. And also that last smalls and piece is that, remember that unfortunately that ZN product is right now worth about $130,000. It's a huge product, and that's why we came in with the smaller product. And so to equate the exposure there, you got the nice, we equated the movement here, the DV01s, to create a scenario where it's like, all right, well, if the 134 put, that's the 14.5 call in this, like Pete said, perfectly negative correlated pairs market here. Now, keep in mind, though, that the largeness of the ZN futures means that you're going to want to look at about a 10 delta spread in ZN, or futures of about 7, 8, or 9 contracts for one ZN call, ZN put that we're looking at here that would make out the S10Y covered call. You have to equate the exposure one way or the other there, because that ZN is very large. And so that's a couple of interest rate products, Pete, that with rates on the move to the upside, getting closer and closer to those historically normal levels, how you use these different interest rate products and the options around them to create essentially a long yield covered call using DV01.